Hello, everyone, and welcome to Stalwart Series at Finacle Institute. Today, we are very excited to host Kapil Gupta, sir. He is a chief economist at Nuvama, and Kapil, sir is responsible for macroeconomic research on Indian and global economy. His commentary on economic issues is widely followed by institutional investors, not just in India, but across Europe and Asia. He has more than 2 decades of experience in capital markets, and we are privileged to have him over for a guest talk and to learn um, a very exciting topic in terms of analyzing Indian economy post-COVID era. Welcome, Kapil sir. It's truly a privilege to host you, sir.
Thank you very much, Shailesh. I'm very happy to be here, and thanks everyone for joining.
So the stage is yours, sir.
Okay, thank you very much. So what I plan to do is, if you guys don't mind, I'll share the presentation. Yeah.
Yes, sir.
So just give me a second. I hope you guys can see it. I'll just make it full screen. Okay. Now, just to avoid some bandwidth, I will switch off my camera for now, and then when we get to Q&A, I'll revisit. I'll be back on camera, if that's okay.
Sure,
What I plan to do, over the time available with us, I will touch upon the current state of the Indian economy, and it will cover the aspects of post-COVID period essentially, but also give you some flavor of where the global economy is also, because ultimately India's economic outlook and economic developments are very heavily shaped by what happens in the global economy as well. So I'll divide my talk into 3-4 parts. First, I'll touch upon just India's linkage with the global economy. I'll introduce the topic. I'll not go into details of it. Second, I'll touch upon the current state of demand in the economy. And third, I'll talk about what are the reasons for somewhat weaker demand at this stage. And in the fourth section, I'll present the outlook as well. Okay, so if you have any questions in between, please park it towards the end. Would be very happy to address those questions to the best of my ability. Okay, so let me get going. First of all, as I said, I just want to introduce this topic. Whenever I speak with somebody for the first time, I just want to make this very clear that ultimately generally there is a perception that Indian economy is relatively isolated. It is not influenced by the global trends so heavily. It's a domestic demand story. It is not China, which is very open to global influences. I want to give a pushback to that notion, really. So, for example, if you look at this chart where we've shown world trade growth rate, which is approximately, you could say for all practical purposes, it is world GDP growth rate. And in the blue line, we shows India's GDP growth rate. And as you can see, the correlation has held up very, very strongly over the last more than 20 years, actually, right? India's business cycle, to simply put, follows global business cycle very, very tightly. If you look at more indicators, for example, BSE 500 companies top line growth rate with the world GDP growth rate or world trade growth rate, you get the same situation, that there is a strong linkage between what happens in the Indian economy companies and what is the global outlook, really. Very, very tight correlations. Especially when I share this presentation with foreign investors, they find it very, very surprising that the correlation is so tight, because they believe that India is very, very domestic oriented story. Now, before as I said, I will not go into much detail why these correlations hold so tightly, but I'll just give you a flavor, where the linkages are coming from. There are 3 kinds of linkages which come from the global economy into the Indian economy. And we should always remember those 3 channels through which these influences come. First is exports channel. Now, if global economy is doing very well, then India's exports tend to do very well. I'm not going to suggest that India's exports are a very big part of India's GDP. They are not. Certainly not as high as China. But nonetheless, It is important because India gets dollar earnings from exports channels. So it's quite valuable in that sense. Second is price channel. And this is where it is very important because ultimately the top line of the companies depends on volume and prices. And it is their top line growth rate which determines their willingness to do capex. Now, top line, as I said, has two elements, volume and prices. And prices, if you see, in India are heavily influenced by the price trends in the global economy. Why I say that is because if you look at some of the very important raw materials which go into the production chains of the economy, for example, energy prices. India does not set the prices on energy. They are set outside India. India is just a price taker in that sense. If you look at various industrial metals, right, which also go into the production chains of any economy, those prices are also set outside India. Potentially, China sets the prices on those commodities, not India. If you look at other food commodities, which also sometimes go into production chains, they're also in many, many commodities, not all. India is not a price setter, India is a price taker. So, if energy commodities, metal commodities, agriculture commodities, the price is set outside India, then it is very, very illogical to believe that the output prices and all these things go into the production chains, then the output prices are very strongly influenced by the input prices. Input prices are set outside India. Therefore, the output prices in India have a strong influence with the global prices, really. And there are periods where global economy is in deflation, prices are slowing down. Then India's companies' top line growth rate also slows down. And when the top line slows down, these companies' operating leverage goes into reverse. They don't want to expand. They may not want to do capex. They may not want to hire people. And the spillovers of those decisions go into the rest of the economy as well. The third channel is the liquidity slash cost of capital channel. Now, if you follow markets, if you follow Reserve Bank of India, if you follow interest rates in the economy, for example, you will appreciate that a lot of the interest rate settings which happen in Indian economy or any other economy in the world, a lot of it depends on what the Federal Reserve is doing in the United States, right? So a lot of this price setting out happens outside India. So the cost of capital is fundamentally shaped by what the Federal Reserve or the Western central banks are doing. We can't diverge from them for a long time very significantly. Otherwise, the exchange rate starts to come under pressure, liquidity starts to tighten, those kind of things really. So for any business cycle, my point is that the trade cycle, the price cycle, and the liquidity cycle are very, very important ingredients of a business cycle. They typically tend to go up together and tend to go down together. And all three are effectively set abroad, not in India. And therefore, India's business cycle has all this very strong influence, which is seen in some of these couple of charts, which I showed you that India's top line growth rate with world trade growth rate and India's nominal GDP growth rate with also world GDP growth rate. Okay, so that was, I just wanted to introduce this, the structure of the Indian economy and the channel of influences which come from the global economy into Indian economy, something to keep in mind as you learn about Indian economy, as you invest in Indian markets, or just as a student who is curious about how Indian economy functions. Okay, now, if there are more things, we can always take in Q&A around this topic. But let me get going to the today's topic, which is current business cycle, how post-COVID economy has been behaving. And I would like to divide economy into supply side and demand side. That is always very helpful, keeps things in perspective. Now, first of all, let me define what I mean by supply side and demand side. When I say supply side, I'm very specifically talking about three, four things. One, how are the balance sheets of the lenders, that is banks, and borrowers are looking like? What is their debt to EBITDA ratios? What is their net NPA situation? Because if the balance sheets are highly levered or there are NPA issues in the banking system, then the ability to lend itself is compromised. The second aspect of supply side is the economic reforms, which enhances the capacity of the private sector to make their decisions, be more efficient, have more visibility and certainty of the policy making, and so on and so forth. And you see, third aspect is how stable is the macro vulnerability indicators, for example, inflation, exchange rate, and those kind of things. So these are two to three very important aspects of supply side, and any economy whose balance sheets are looking very good, inflation is under control, exchange rate is stable, and doing economic reforms, I would simply say that that economy is supply side ready. Okay. When I say about demand side, I'm talking about very ordinary things which we typically talk when we think about economy. For example, how is the incomes and profits for the corporates? What is the consumption demand? What is the exports demand? What is the investment demand in the economy? Very simply put, the GDP equations, which will say is investment plus consumption plus net exports, right? So that becomes the demand side. Ultimately, a good business cycle is one where supply and demand are moving hand in hand. If one is out of whack with the other, then you run in different kinds of problems, right? Right? And I'll give you examples also. So, if you, for example, if you look at the current state of the Indian economy, or rather, I should say, you know, if you look at the three economic upswings which we have seen in last 25 years, first was from 2001 to 2 downturn. We started to bounce back from that downturn. It was a global recession. Second was after the GFC, global financial crisis, we bounced back from the lows. And third is after COVID. In all these three upswings, you will see that in the first upswing, 2000s, uh, you know, Mr. Vajpayee was in power. He did a lot of efforts in fixing the supply side of the economy, balance sheets, economic reforms, and everything. But the demand side took some time to come back, and and that was one of the reasons why demand, the election results were very surprising in 2004, if you guys recall, or maybe you've read about it. Everybody is expecting a win, but Mr. Vajpayee lost elections. One of the reasons was there was a weakness in demand in rural economy and so on and so forth, even though he did a very good job at fixing the supply side of the economy. So supply was in place, demand was somewhat weak. In 2010, when we bounced back from GFC, demand was strong, but the supply side was weak. So the problem flipped. There was a big demand comeback from the GFC lows, but there was policy paralysis, inflation was running high, exchanges started to fall, fiscal deficit was very high, current account deficit was very high, right? And balance sheet started to look stretched. So it was a situation where demand was there, but supply was missing. And we ran into the problems of exchange rate falling, inflation running high, and those kind of things. When we talk about post-COVID recovery in light of these, it was somewhat similar to the early 2000s that Indian economy is supply side ready and demand side deficient. I repeat, as things stand today in the post-COVID world, a lot of work is done on the supply side, but we have a problem on the demand side. Let me explain that. For example, if you look at India's current account deficit, it is always the first thing to look at because that's where the global situation can really turn adverse for us. So if you look at, today India's current account deficit is 0.7% of the GDP, trade deficit for all practical purposes, imports minus exports, right? It's very, very contained, under 1% of GDP. We have in 2009, 10, 11, 12, it was very, very high. So that vulnerability is much less. If you look at inflation of India, it is also within the range of Reserve Bank of India of 4 to 6%. So not a big worry. Unlike Western countries where inflation went very high, India has been able to keep its inflation under check, frankly speaking. Right? If you look at the balance sheets of the banking system, for example, net NPAs as a share of total assets, that's also near record lows. So banks' balance sheets are in very, very good shape, which is also enhances their ability to lend. Right? You also see large borrowers, for example, BSE 500 companies, their debt to EBITDA, that has been dropping, which means that these companies have been able to deliver, right? That's also very, very good thing. So I've shown you a few indicators to suggest that India's supply side is in a very, very good shape. However, And then obviously, series of economic reforms which the government has been doing since 2014, very, very commendable job in terms of whether it is tax related, spending related, whether it is taxes for the corporate ease of doing business, whether it is for households in terms of DBT transfers, right? Real estate RERA is there. There's a bankruptcy code. A lot of economic reforms have been done in last 7, 8 years. It's a long list. So that also has enhanced the capacity of the economy to function. However, we are seeing the demand is little bit weak, right? So some of the ways to look at the demand side of the economy, for example, GDP. If you look at the left-hand side chart, you will see that India's nominal GDP is still undershooting the pre-COVID trend line, which is shown in the dotted line. The right-hand side chart shows you the real GDP, which is volume-based indicator in some sense, is also undershooting the pre-COVID trend line. We have not been able to retrace that back because we slipped under COVID. We came back, no doubt, but we have not been able to reach that pre-COVID trend line. In fact, to be fair, very few economies in the world has been able to achieve that. And later on, I'll show you charts about China and Europe particularly, which are also struggling below the pre-COVID trend line. There's only one country which actually is back to pre-COVID trend line, which is United States of America. Rest of the world is actually a little bit struggling below the pre-COVID trend line. Now, I'm going to show you 6, 7 economic indicators, which are widely tracked, highly reliable, high frequency indicators. And I have shown you 5-year CAGR rolling so that the COVID disruptions do not influence the data. Because COVID period is highly disruptive period. We went into lockdown, then came back, then again went into lockdown, then again came back. It has been a bit of a seesaw. So 5-year CAGR rolling trends give you a good picture of where we are settling in terms of underlying activity. So this is the money supply in the economy, or you could roughly say deposit growth rate in the system, which is on the weaker side in terms of historical trend. This is India's total tax collected in the country, very highly reliable indicator. That also has been, we saw a very good phase in 2002 to 2008-9, but then it has been a bit of a drift on the sideways side. This is the exports of India, goods and services growth rate. As you can see, we are kind of topping out already, and it is about single-digit growth rate in exports. We have seen better days in early 2000s, really. If you look at cement volumes, cement is an important ingredient into the economic activity, real estate, infrastructure, road building, those kind of things. So cement volumes is something which we track closely as a proxy for Indian economic strength. This is 5-year rolling CAGR. Again, it is peaking out at a level which is lower than every single year between 2003 and 8. If you look at commercial vehicle sales, now these are the transportation sector. If economy is doing typically very strong, demand is strong in the economy, you will expect a very strong momentum in the commercial vehicles, trucks, basically truck sales, really. 5-year CAGR trend is more like 1%, which is somewhat on the weaker side, really, and speaks to the weakness in the demand. This is fuel consumption, which is diesel and petrol volume consumption in the country, which is again goes into all sorts of activities, whether it's corporates, industry, households, all sorts. As you can see from historical perspective, it is lower end of the historical ranges. This is BSE 500 companies top line growth rate. 5-year CAGR rolling. As you can see, it is peaked out at a level which is lower than every single year between 2003 and 8. And it's quite muted, and what you could say that it is at the lower end of historical ranges, much like many other indicators which I showed you. All these indicators are very, very reliable and consistently point towards one common sort of understanding, which is that the demand side of the activity is somewhat on the lower end. It's not very robust. However, that said, there is one indicator which has genuinely improved and impressive. This is BSE 500 companies profit CAGR. It is running at 20% today, 5-year CAGR, which is very impressive. If you compare it with 2003 and 8, it is still matching that kind of momentum. Very, very brilliant comeback of profitability. And that is one of the reasons why markets are also excited, because companies have been able to generate good profits. But there is one thing which we must keep in mind. You should see the profit indicator along with the top line indicator. What these two charts together show you is that this time, profit growth rate is 20% on a 5-year basis. The top line growth rate is more like 10%. So the profitability is not coming so much from the top line growth rate. It is coming from the margins. If you look at 2003 to 2008, profits also ramped up then also, but that time the profits came from the top line. This is the top line acceleration during that period. So in other words, what is the difference between the profit upswing after COVID and profit upswing after 2002? Is that both are impressive, but the first one came with top line acceleration, the second one came with margins. Now, why this is important? This is important because profits are always welcome, no questions about it. But the sources of those profits are very important ingredient in terms of deciding for the businesses whether they want to do capex or not. If the profits are mainly coming from the margin expansion, like credit cost of the banking system coming down, commodity prices coming down, so on and so forth, they may want to hold back capex because they're not sure whether the demand is there or not, right? So that's why. So this, so in this section, my idea was to show you a very series of very reliable indicators of where the demand side of the economy is. And in the previous section, I showed you where the supply is. And one line conclusion from both the slides, both the sections is that Indian economy has done a tremendous job on fixing the supply side of the economy. When the government came in 2014, new government came in 2014, I mean, most of these parameters were looking very, very bad. Inflation was high, current account deficit was high, fiscal deficit was high. By the way, India was counted in fragile 5 in the global economy, right? We have come a long way and fixed a lot of things on that front, but there's much to be desired on the demand side is what my point is. Okay. With that, I move. Oh, by the way, I forgot to mention before I come to the reasons why demand is weak, I also want to show some of the indicators which are that while aggregate demand is weak, there is a bit of a K-shaped recovery, in case you're familiar with the term, that certain pockets of the economy are doing very well, the upper leg of K, and certain sections of the economy are a little bit lagging behind, which is the lower leg of K. So, for example, if you look at automobiles data, now this is again a very, very clear, clean indicator, right? I have shown you premium cars, two-wheelers, and small car sales volumes in 2003 cycle, from 2003 to 8, and F19 onwards, which is where the post-COVID period lies. As you can see, in the 2003 to 8 period, small cars, two-wheelers, and luxury cars all were ramping up pretty much neck and neck. In the post-COVID period, it is mainly the premium cars, which is shown in blue line, which has sold like hotcakes. But if you look at two-wheelers, if you look at small cars, it has been a bit of a struggle, right? Something to keep in mind, right? That it speaks to the K-shaped recovery in the economy, where upper leg of K is represented by people who work for BSE 500 companies, invest in stock market. Stock market has done very well, so there is a wealth effect with them. These were the guys who were work from home during the COVID days, dark days of COVID, right? They did not lose a salary. They continued to work, those kind of things, right? So, but the various other individuals in the country, it was a little bit, COVID fell more heavily on them compared to the high end. If you look at real estate sales also, this is the square feet sold in top 10 metros of India. The topmost line is houses priced above 3 crore. The middle line is prices, housing sales prices 1.5 to 3 CR. and blue is for the homes which are 1.5 CR and below. As you can see, there is a K-shaped kind of a pattern in the real estate sales as well. In fact, if you look at the taxes collected by the state governments from the real estate sales, which we call stamp duty, that will give you a good sense of how the aggregate real estate market is doing. And this is the 5-year CAGR rolling of the stamp duty collections by the state governments. It is peaking out at a level which is lower than every single year between 2003 and 8. In other words, some pockets of very high-end luxury homes, just like luxury cars, are selling very, very well, but not everything. In fact, we also looked at the top line of the durable companies which should benefit from the real estate boom. For example, the whitewood companies, tile companies, right, paints companies, Havel's kind of companies. Their top line is very, very muted, despite supposedly real estate boom going on in the country. So the multipliers of real estate boom on the real estate tax collected by the state governments or on the top line of the companies which serve the real estate market, both are missing. And the reason it is missing is because it is a K-shaped recovery. Only small pockets, some pockets of real estate are doing very well, not everything. This is the market cap to GDP for India, equity markets blue line, and the green line is the GDP growth rate. So as you can see that the GDP growth rate is more like at the lower end of historical ranges, but the market cap to GDP has crossed 2007 levels. Okay, so this was just to give you some flavor of the current state of supply and demand in the economy. Supply is ample, demand is average to below average, and within that, it is a K-shaped pattern with some pockets doing very well and some pockets kind of struggling. Question is why? Why this is the case? This brings me to the third section, why demand is weak. Now, before I get into the evidence and the data, I want to bring this concept of macro recycling. And here, it is very important that we present an analogy. For example, okay, let me start with first, what is macro recycling, and then I'll give you an example. Macro recycling, whenever an economy goes into an economic upswing after the downturn, it starts bouncing back, for example, there are certain segments of the economy, certain sectors or certain corporates or certain individuals, which start to benefit early on, and others who are laggards. Okay, always happens. Now, for the business cycle to keep moving forward, it is important that the early gainers in this business cycle upswing should recycle their profits and incomes back into the economy into spending streams. So, for example, if corporate has started to see profitability accelerating at a very rapid pace early on, it is important that corporates recycle their profits into capex very adequately, so that these spending streams become the income stream for the downstream segments. Downstream segments meaning MSMEs, micro small enterprises, middle income households, lower middle income households, lower poor income households, right? And once the MSMEs start to see their top line growing, they start to hire people. When they start to hire people, migration kicks in from the farm sector to the non-farm sector. When that happens, productivity goes up. When productivity goes up, incomes, consumption, savings go up. Consumption becomes the top line, savings fund the investment, and that's how the cycle propagates. One of the ways to understand this analogy is a bicycle. If you're riding a bicycle, but you stop pedaling it, then bicycle will go on for a while, but eventually will begin to lose momentum and eventually topple. So it's very important for a bicycle to keep going that you continue to pedal it. Similarly, for economy to keep going forward, it is important that somebody keeps pedaling it, or recycling this is very, very essential, right? Now I'm going to show you 4 areas where this repedaling or recycling is stuck. First, if you look at what's happening on the global side, as I already showed you, that typically Indian economy follows global trends very, very closely. What is going on in the blue line is the US consumer demand. As I said, US consumer has been very strong. US economy has been very strong in the post-COVID period, thanks to the government free money given out to the people, to their people, right? But US consumer is strong. But if you look at the green line, world export growth is actually stagnating. So world is not benefiting from the US consumer demand, right? In other words, US consumer demand is not recycling into higher exports for emerging markets like India or other countries, right? So that's one recycling which is currently missing. Uh, and one of the reason is that if you look at, this is very important chart in global macroeconomics today. The first chart shows you US consumer demand relative to pre-COVID trend line. It is back to the pre-COVID trend line. If you look at lower two charts, China and Europe, they are struggling below the pre-COVID trend line. In other words, the consumption demand in Europe is struggling, consumption demand in China is struggling. It's only the US where consumption demand is good. But consumption demand is not recycling into higher exports for emerging. So emerging markets like India are not being able to take any benefit from the US, strong US consumer demand. So that's first recycling problem, that US consumer demand is not recycling into higher exports. The second is, if you look at Indian government is collecting a lot of taxes from the upper leg of K in India, because upper leg of K is the one which is a tax paying arm. 8-9 crore people in India pay 90% of the income tax in this country, right? So a lot of income tax is being collected from the high income individuals in the country, which is shown in the green line. However, government is using these tax collections not to spend back into the economy. It is not recycling into the economy. As you can see, the blue line is actually flat, which is the spending. Government is using it to fix its balance sheet, to reduce the fiscal deficit. So the tax revenues are not recycling back into the economy. They are going into government fixing its balance sheet, which is a good thing because government needs to be fiscally prudent. But at the same time, there is a negative side of it, is that the money is not coming back into the economy. That is the second recycling problem, which is there in the economy right now, right? Third problem is BSE 500 corporates. They also represent the upper leg of K. They have been beneficiaries in terms of gaining market share from the smaller guys. They were the work from homes. They have access to equity markets. They are in a much better position. As you can see, the green bars, that is the profit growth rate over the last 20 years. In the green phase, we got profit growth rate, which was very impressive. And then it is only post-COVID world where we got the profits back. Otherwise, between 2008 and 2019, the profit growth rate average is low single digit. It was a bit of a struggle. So the good news is that post-COVID, BSE 500 companies have been able to show good profit growth rate. However, as I said, entities which have shown profits in the business cycle, it is important that they recycle their profits back into the economy in the form of capex. But what is this blue line showing you? Blue line is the free cash flow of these companies. Now, blue line is very elevated, as you can see in the pink shaded area. What it tells you is that these companies are not recycling their profits adequately into capex, right? And until they recycle their profits into capex, the downstream corporates like MSMEs, they don't get their orders. It is only when large companies start to put up a big plants and manufacturing units that small companies start to see order book growing. But if they're not going to do capex, then obviously it will not flow into the economy. Unlike this was very different in 2003 and 8. Look at the green phase here. Profit growth rate was very significant, very good. But the free cash flow started to drop very rapidly during this period, which means not only profit was growing at a very rapid pace, but it was rotating into capex as well. This time, this is not happening, right? And one of the reasons it is not happening is that corporates' profits are coming not from the top line, but from the margins, the point I made in the beginning as well. So they are not very confident of demand in the economy, right? So companies are holding on to their good balance sheets. For example, if you look at this chart, this is BSE 500 companies' debt to GDP. It has been consistently dropping, which means whatever profits they have, they are being used not to rechannel into the economy, but to fix their balance sheets. In other words, the two entities in India, government and corporates, who are beneficiary of K-shaped recovery in the sense that they are the upper leg of K, they are focused on balance sheet. So whatever revenues or profits or tax revenues are coming to these entities, that is not finding its way back into the economy, that is going into fixing the balance sheets of these two entities. Very, very important point to note. This is where recycling is getting stuck. Now, we are left with the lower leg of K, which if you see is represented by households, broader households, MSME, which is micro, small, medium enterprises, and the agriculture sector. Now, because if government is not recycling their tax revenues back into the economy, corporate is not recycling their profits into economy, the income dynamic of these segments is relatively weak, but they are taking loans at a very rapid pace. The loan growth in this segment is growing at 18 to 25% YOY. Large industry, on the other hand, is hardly borrowing. So you see this K-shape in the lending landscape in which entities where profits are very strong, balance sheets are good, large industry that is, they are unwilling to borrow. And entities which are somewhat weak on income dynamics like households, MSMEs, agriculture, they are borrowing very rapidly. Now, despite the borrowing, their demand in the economy is very weak. I already showed you several indicators that despite households leveraging up, the demand in the economy is relatively weak, which means that potentially, and nobody knows for sure, but one of the explanations could be that a lot of loans which these people are taking, they are barely replacing the weakness in their incomes. And therefore, it is not showing up in the consumption demand in the economy. And because the consumption demand is not there, the top line of the BSE 500 companies is weak. Because their top line is weak, they are not doing capex. They are not doing capex, then MSMEs are not getting the orders. If MSMEs are not getting the orders, they are not hiring people. If they are not hiring people, then the migration from farm to non-farm sector is stuck. If that is stuck, then incomes and productivity is stuck. And therefore, consumption is weak, even despite taking loans. That is the circle which is going on to some extent at the economy level. So my point is, if I have to summarize why there is a demand problem, it's simple is that US consumer demand is not recycling into higher exports. Indian government tax revenues are not recycling into spending. BSE 500 companies' profits are not recycling into capex. And lower income households, MSMEs, and agriculture loans are not recycling into demand. Basically, it is behaving like a bicycle which nobody is pedaling. And if you don't pedal the bicycle for a while, it will slow down and eventually topple. That's the problem going on here, to my mind. And that explains why there is a demand problem in the economy, really. So this is the recycling problem in which the economy is stuck. Now, obviously, there are solutions to it. It's not that this is a problem which we have to sit on our hands and watch. There are three ways we can come out of this problem. First is, for example, how we can kickstart macro recycling. The first is if exports pick up. This is the total exports of India. As you can see, service exports are weak, manufacturing exports are weak. But if global economy starts to show more strength, if China starts to show more strength, then India's exports can start picking up. And if India's exports start picking up, then corporate top line will start accelerating, which will give them confidence to do capex, and the whole cycle can start to function properly. But it is not, to be fair, it is not going to be easy. And the main reason why it is not easy to boost exports, particularly goods exports, is China. Now, what is going on in China is that China is a country which is 33% of global manufacturing and 13% of global consumption. So it produces a lot, but it does not consume a lot. So it produces a lot of surplus, which it does not know what to do. with. So what China does, it dumps goods on the rest of the world. Solar panels, solar modules, maybe steel, maybe electric vehicles, you name it. China is producing at a very cheap prices and is dumping on the rest of the world. The other day, there was a Financial Times article which talked about Europe inviting bids for building an electric train in Europe. There were two companies which put up a bid. One was Spanish company and one was Chinese company. And Chinese company bid was 47% lower than the Spanish company bid. How do you compete with a country like this, which does not care about profits? So one of the threat to India's exports is actually China's overcapacity and their willingness to sell those goods without making profits. And that is why it is not going to be easy for any country, because in India, ROE, return on capital, return on equity is very, very important. You don't want to do a business where return of capital is not there. Whereas China does not care about return on capital. So that is one challenge India is facing. The second solution is that Indian corporate accelerates the capex. That will start the micro recycling. But again, it's not easy, because what is happening is that if you look at this chart, this shows you the top line growth rate of BSE 500 companies and the profit growth rate. For the last 5-6 quarters, while top line was in single digit, profit growth rate was still accelerating. But of late, you begin to see that the green bars have also started to converge towards the blue bars. So in other words, in last 1 year, top line was weak, but profits were strong. Now we are beginning or entering a stage where top line and profits both are looking weak. So why would a corporate whose top line is weak and profit is weak should do expansion? It should not. So this solution looks very tough again, right? The third is that government of India stops fiscal consolidation for some time and spends even more aggressively into the economy to start boosting income and capex in the country. But government of India is bound by the rules, fiscal rules, where it has committed itself to reduce India's fiscal deficit consistently towards 4.5% or below, in case you are following. So they are very, very balance sheet focused, and they are not, they are unlikely to 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 actually expand fiscal deficit, right? So if these three solutions are looking difficult, these are the right solutions in my view, but they are not. I have to be realistic that they are not looking very, very likely in the near term. Exports pick up looking likely. In fact, there's a US recession risk which is going on. So exports performance is unlikely. Corporates picking capex is unlikely in my view. And the government is committed to fiscal consolidation. And therefore, the near-term solution is unlikely. And therefore, my point is that what might happen is that in absence of pedaling, bicycle might slow down. So this K-shaped recovery, whose upper leg of K is represented by US consumer demand, India's BSE 500 companies' profits, India's luxury consumption, that is likely to slow down towards the lower leg of K. So the reconciliation between the upper leg of K and the lower leg of K happens with the upper leg of K slowing down rather than the lower leg of K moving up. And therefore, economy could lose some buoyancy in the near term, some economic strength in the near term. But to be fair, India does not have a balance sheet problem. India does not have current account deficit problem. India does not have inflation problem. India does not have exchange rate problem. So it would be a modest slowdown. We might be entering a phase of modest growth. In case you followed the GDP data which came on Friday, it is first time we got into a 6% handle in 5-6 quarters. The FY24, we grew somewhere around 8%, and the first quarter growth rate is more like 6.7%. So we are entering a phase of soft patch. It's not a big problem. It will sort itself out eventually, but it's important to know that we are entering a soft patch of earnings and growth, while valuations in the markets are very high. So I'll stop here. I wanted to leave some time for Q&A or comments or thoughts or something which I've not touched upon and you wanted to ask. I'm more than happy to answer, really.
Uh,
Thank you
Sir,
very much.
thank you so much for detailed presentation. I do have quite a lot of questions on chat shared by the students. I request everybody to please make sure you flow it through me. So in case if there are any overlaps, I cover it through moderating those questions at this platform. So I just wanted to ask, so when you talked about uh, the corporate profits going up and the sales slowing down, uh, and at the government level, the focus on uh, you know, uh, making sure not spending too much of the tax collections and then eventually moving along. However, the government has been trying to take initiatives like PLI. Where does it form in terms of quantum? I have very little scope or understanding of that topic. So I just wanted to understand the initiatives which the government has taken in terms of influencing the supply side. Uh, the PLI schemes and everything. How does it pan out in the post pandemic era?
Yeah. So I think PLI has been consistently expanding. This is the government's significant attempt, I should say, to boost India's manufacturing. Right now, the issues are twofold. Okay, let me say this upfront. Can PLI lead to some few economic stories becoming very big? I think potentially yes. But can PLI in and of itself will give a brought a big manufacturing scale up of India? That is yet to be seen. There are two reasons. One is in the near term, businesses will do capex when they see demand. Just by giving a little more incentive to a corporate to do more capex and build plant will not be sufficient, because if corporate doesn't have a confidence on demand, he would rather not expand his business. Otherwise, operating leverage tends to go in reverse, profitability gets impacted, and so on and so forth. So there's a you can boost supply side, but you also need to boost demand side at the same time. Otherwise, the results will be very half-hearted. Number one. Number two, what is also happening is that while India is making all these attempts to boost its manufacturing, which are all genuine attempts, China, on the other hand, I made that point earlier also, has so much capacity that whatever incentives we give to our manufacturers, China has the ability to give even more incentives to their manufacturers and sort of offset those incentives. For example, exchange rate. China tends to keep its real effective exchange rate, which is the competitiveness of exchange rate, very, very undervalued. So it tries to that undervalued exchange rate tries to give a fillip to their manufacturing sector at the cost of other countries' manufacturing sector. So it is not just the PLS scheme. We have to think a little more holistically, maybe think about a little bit overvalued exchange rate of India, which is also hurting scale, and so on and so forth. So PLI is a good initiative. I think it needs to be complemented with some other initiatives on the supply side, but also on the demand side as well.
Got it, sir. Thank you so much, sir.
Yeah.
Sir, I think I read it somewhere. I can't recall the source now. But in the current budget which was presented, in the document itself, it's mentioned that the primary deficit of India stands around what 1.5 or 1.7%. I don't remember the exact
Yeah.
number, but that happens to be sort of like I think a 10-year low or something like that. On the contrary, don't you think the consolidation phase of the government is seems to be over and now it can kickstart on the spending part?
Yeah, I wish a little bit of that happens, Shailesh, but I tell you, the government targets are more in terms of fiscal deficit, not primary deficit. Because there are interest payments also in that, right? So, for example, today the government's fiscal deficit stands at 4.9. I mean, for FY25, they are going to reach. Okay, let me put it this way: FY24, we finish at 5. I think 7 or thereabouts, and they are taking it to 4.9% next year. F25, that is. F26 target is 4.5%, and potentially they might go below that after that. So there's some path pending still for the next couple of years that government will continue to do fiscal consolidation. So it's very difficult to spend while you have targets on fiscal consolidation, really.
Got it. Got it. Thank you so much, sir. Sir, if you can please scroll to slide number 28
Yeah,
and 29.
just a moment. Yeah.
Sir, on this data, I just wanted to check like the slump in the stamp duty collection post-COVID. There were quite a lot of states which had slashed stamp duty registrations on real estate properties to boom or sort of create sort of stimulus in the real estate domain. Maharashtra being one of those, where the stamp duties I think were slashed 50% for quite some time. So the data may be a little low on the collection front. Is that a possibility, or that happens to be a very insignificant amount of the overall
No,
collections?
no, so that's a valid point. But the only thing is that 2 years back, most of the duties have come back to the same point. So if you're looking
Yeah,
at today's number F24, its base
got
is
it.
F19. Between F19 and F24, we went down on stamp duties and we came back on stamp duties. So neither F19 is distorted nor F24 is distorted. Duties are same. Okay. So it means duties cuts are not
Got
influencing
it.
the 5 year CAGR number. Whatever happened in between happened, it came and then it reversed.
Yeah, got it. Got it. Got it. Fair enough. Thank you so much, sir. Sir, on the same slide, one of our alumni, Yash Suntali, has a question. Yes, you want to ask?
Yeah, hi. Hi, sir. Thanks for
Hi.
the opportunity and insightful presentation. So my point is like you explained very well on the macro side, but when I listen to different companies on the company level side, what they say is ki the sales of the real estate has been good in last 4 5 years, and now we can see that coming in the white goods or the building materials like wood panel or the faucetware side. So how we can correlate it better with the stamp duty and the demand coming in the
So
building
we'll have to
material
see.
products.
Yeah, we'll have to see. We'll see over the next 6 months whether this demand, for example, if you look at this just stamp duty, but you also look at the durable companies' top line growth rate, right? If sales of the real estate companies are growing at a very rapid pace for 4 years, where is it is so far it has not shown at all in the company's top lines, right? Which deal directly with the real estate. Now, if you look at 2003 to 8 period, there as the sales in the real estate market grew, because they were very, very broad based, it showed up in tax collections, as you can see in the green face here, and it showed up in the durable companies top line almost neck and neck. There was not a 3 or 4 year delay in that at all. This time, so point I'm saying is it's not that some pockets of real estate market are not doing well. They're doing very, very well.
Mm.
But doesn't mean that whole of India's real estate is doing very well. And that is keeping a little bit of a tab, sort of pulling it back or held back because of that is what my sense is. But we'll see. If this begins to pick up, then yes, that is one way the recycling can kick in.
Got got it. And just a follow up, like you said, some parts are doing well and some are not. So if you can throw some light, like if you know tier two is doing well, or if may
So,
you know.
so, so for example, luxury cars are doing very well, as I showed you, right?
Hmm. Correct.
Right? Luxury hotels, tourism is doing very, very well. Luxury jewelry has been doing very, very well, right?
Hmm.
The large corporates are doing very, very well, right? When I say large corporate, I don't mean to say mid caps are not are small. Mid caps are also large from India's standpoint. When I say MSME, I'm talking about companies with 10 employees, 8 employees, 12 employees, and those kind of things. Very, very small enterprises. They're it feels that they are a little bit of a struggle there, but listed company space has been doing very well. Airlines again has done very, very well.
Hmm.
But if you look at today, the from Hindustan Unilever to pizza companies to shoes companies to textile companies to even little bit lower end this thing, you will see some weakness in volumes. Today's, I mean, real estate is doing very well, but why cement companies are not able to deliver volumes? They're
mm,
struggling with very poor volume growth rate. If they take price hike, the volume dips immediately, which means that there's a demand problem. Now, somebody should ask this question, that if government is spending so much on infra and there's a real estate boom going on in the country, why cement companies are struggling for volume? Right. So it speaks to the K-shaped recovery is what my point is, really. All this adds up only in one way, that some pockets are doing very well, but not
mm.
all pockets are doing great.
Okay. Got it. Thanks a lot, sir, for answering my question.
Yeah, sure. Thank you very much for asking.
So just a follow-up question on the the SUV slide.
Yeah.
Can you please yes, sir. Thank you so much. So just wanted to check. I got a bit curious. Has this data been adjusted? So when you say two-wheeler, does it include the EVs or does it not?
So it includes all the two-wheelers, which the data is published. I'm guessing it
Okay,
includes, yes, right? So two-wheeler demand has started to pick up only last 1 year. Otherwise, it has been a bit of a struggle, as you can
right.
see, right? And that green will not change dynamic very materially, frankly. Even small cars are struggling. If we are seeing this companies segments after segments where the lower end has been a bit of struggle, right? So I mean, that's pretty evident across sectors, just that it is taking longer to reconcile. The ideal scenario would be that these lower guys pick up so that the recovery broadens out, rather than the blue guys slow down and the slowdown broadens out.
Got it. Fair enough. Um, Sir, with the improvement in GST collections, the betterment of the infrastructures, the less fuel consumption resulting into betterment of the deficit data points, do you see it improving a little more faster when the fiscal position goes, as far as the fiscal position goes? Or do you see that cycle repeating again, due to some inefficiencies kicking in or some or the other shock around the corner?
So as I said, Jalesh, I think the economy is quite, uh, let's just say, ready in terms of capacity, right? I mean, when I say capacity, I mean to say that if growth comes back, demand comes back, we'll be able to grow without generating inflation and overheating signs or current account deficit and those kind of things. And that can give us a prolonged economic upswing. But just that we are not, the demand side is weak. So in other words, what I'm saying is that a lot of this DBT, a lot of these efficiencies which corporates have been able to build in, a lot of these economic reforms which have allowed a little more transparency in policy making, um, you know, that has, you know, gone a long way in readying the economy for our next upswing. Just that we have to wait for the demand side, and I'm fairly confident that once the demand side picks up, this economy can really sustain a prolonged upswing without generating those vulnerabilities which typically come with demand, current account deficit and inflation, for example. So there are efficiencies, no doubt about it, but I think uh, it's difficult to deny that there's a demand problem also.
Got it, sir. So, I wanted to ask, any particular, uh, legislative actions which are in pipeline can swing the needle in our favor by quite a lot if it goes through properly, according to you? Any important government, I guess, regulation which might come in our favor in the next 4 to 5 years?
I think, see, the agenda typically, which is there on the reform side. Now, first of all, of course, we should acknowledge and congratulate government on some of the very tough economic reforms which this government has undertaken, frankly. Right? If we're sitting in 2014 and somebody would have told us that in the coming 7, 8, 10 years, you will have GST in place, you have DBT in place, you have bankruptcy code in place, you have corporate tax cut in place, ease of doing business rankings will improve, you have RERA in place. You see, I mean, that's a lot of ground already covered, frankly, right? And we should also be mindful that what happens with these economic reforms is sometimes in the near term, they are disruptive. The benefits of economic reforms are almost always back-ended, right? So, so in fact, I would suggest that we should take a pause on economic reforms now that we have done a lot already. We should allow those benefits to trickle in now before we do more economic reforms, which might be near-term disruptive. right? So it is important that we consolidate the benefits of what we have already done and achieved in terms of economic reforms by allowing the demand side to come into the economy, profit, jobs, incomes, you know, per capita incomes, they all start to accelerate. And then we'll reach a stage where we might need another round of economic reforms, for example, labor laws or land reforms, which are even tougher nuts to crack, frankly, and their state's involvement is much more than other reforms. But but I don't think those are binding constraint on the economy right now. It's not that we have to do those reforms before we can hope for a recovery, is what my point is. Those reforms can wait. We have done already a lot on economic reforms, really.
So you mentioned, and it actually quite a lot of wisdom in that one single statement. Benefits of these reforms are back-ended. So any particular reform where you feel the benefits are yet to kick in, and perhaps you see those benefits kicking in next 3 to 5 years?
So, for example, let's just say bankruptcy code, for example, right? When we, if you recall, to 2012, 13, and all, NPA started to accumulate in the banking system, but it was not until 2015, 16 when RBI had to do AQR, asset quality review, and force some of these banks to acknowledge those NPAs because they were afraid that, these cases will go to for NCLTs and stuff like that, in legal hurdles. They will drag on for a long while. When we get into a next cycle, and at some stage there are certain pockets where excesses get built up, they can be resolved very, very quickly, because now the processes, the agencies, the jurisdictions are fairly clear how that process is going to go forward. Similarly, GST, for example, right? Now GST has been started to implement 2018 onwards. Now it's been quite a while, but in this we had NBFC liquidity crisis in 2018-19, so we did not get the full benefits of GST. 2020 we get into lockdown one, 6 months are gone. Then we begin to bounce back from a very weak state. Then we get into another lockdown in 2021. Then we get a bit of bounce in 2022. But then now we get global economy started to slow down now. So we haven't really, Shailesh, seen a period where, corporate tax cut, GST benefits, they economy is in a good shape that we start taking the benefits of that in a more meaningful manner, right? That we have been a little bit unfortunate in that sense, let me call it, because of the series of events that happened after that. So a lot of these reforms are ready to deliver if economy goes into an economic upswing.
Got it. Fair enough, sir. Thank you so much, sir.
Yeah.
So there's one question in
Yeah.
chat. Would it be correct to compare our current percentage changes, obviously, for various indicators with, maybe, 10, 20 years back indicators? Quite a lot of things have changed, making the data point maybe in certain situations non-comparable.
See, if you see, for example, if you look at China, for example, China started to grow in 1990s or late 80s, 1990s. Uh, and they showed growth rates like we saw in 2003 to 8 for more than 15, 20 years. We showed them for 4, 5 years. And today we are at $3.5, 3,500, 3,000 to $3,500 per capita income, which is by global standards is a low income country. If you want to go to 10,000 to 15,000 per capita income, you need to generate those kind of growth rates, which I showed you in 2003 to 8, for a sustained period of time to be able to make dent into the poverty levels, absorb the demographic dividend gainfully, right? And and become a middle income country. If at 3,000 per capita income, we start to argue that, okay, we can't, our base has become high, we can't be generating growth rates of 15, 20% anymore, then it's going to take forever to get to the middle income country, frankly speaking. All the countries which have become middle income to rich, South Korea, Japan, China, they have grown at 8 to 9% compounding real GDP growth rate for more than 20, 25 years, not 5, 6 years. Right? So, yeah.
Got it, sir. Got it, sir. Sir, there's one question from again a team member, would it be relevant to track lower spending of government and private spending with GFCE and GCF as a percentage of GDP on quarterly basis, and track consumption demand with PFCE as a percentage of GDP and quarter on quarter growth?
Yeah. So that as well as I said, you can do YOY numbers quarter to quarter. Issue that happens is that first of all, many of these indicators are not now showing very slow growth. For example, quarter to quarter nominal GDP growth rate is showing 9 to 10% growth rate for 7 quarters now. It has been single digit for 7 quarters on YY basis. I've shown you 5-year CAGR numbers because I wanted to overlook the impact of going down and coming back up. We went down minus 15%, we bounced back plus 30%. So all these numbers are, different sectors are showing pent up in different levels. So that's why I took F19 to F24. But if you're interested in YY numbers, then YY numbers for export growth is more like 3-4% quarter to quarter. YY numbers of companies top line is running at 7-8%. YY for nominal GDP is running at 9-10%, right? So, and if you look at the capex now, since somebody mentioned about capex, I'll show you chart here. For example, look at this chart. If you look at the central government capex as a percentage of GDP, left hand side chart, there is no doubt that the central government has lifted capex quite significantly. It has almost doubled the left hand side chart. The government's push towards capex and infrastructure and so on and so forth. But if you bring your attention to the right hand side chart, this is the capex done by not just central government but also state governments and PSUs. PSUs like NHA, National Highway Authority of India, or Indian Railways, and some of the big PSUs like Coal Indias of the world, ONGCs of the world, and all that. If you club them together, it will give you a public sector capex as a whole, not just central government. And as you can see, as a percent of GDP, it is flat for about 7 years now. Right? So as a percentage of GDP, it is not. That's why the multipliers of government, central government push to it has doing a very genuine thing to push capex, but the other entities are not fully on board. So one hand of the government is slowing down capex, the other hand of the government is accelerating capex, but the picture is more like stable. Is the point I'm trying to, and that's why you don't see the multipliers in the economy in terms of corporates taking advantage and crowding in and those kind of things. Really, same thing is happening in real estate, right? Your real estate is booming seemingly when we look at Godrej and Lotas of the world and Shobhas of the world and DLFs of the world. But where is the multiplier in the tax revenues? Where is the multiplier in the durable company's top line? Right? Similarly, consumption loans in India are growing by 23% YOY, 24% YOY, 25%. This is a very rapid growth in the consumption loans. But the consumption demand in the economy is about average. Right? This is why RBI is getting a little bit worked up also, that where these retail loans, why there is so much excess going on in the retail loans. That's why RBI is doing regulatory tightening to slow them down a little bit, because, frankly speaking, the demand coming from these loans as a result of these loans is relatively weak. So this is all this K-shaped pattern in some sense, which is playing out to my mind.
Got it, sir. Thank you so much. Sir, just one question on this slide. So is it because the revenue collection ownership has changed? That's why the spending pattern has changed in last 3 to 4 years
No,
from
so
state to
spending
central?
pattern, yeah, okay. Well, not entirely. I think the bulk of the reason is that PSU, NHI, Railway, Indian Railways, for example, they were borrowing and doing capex until 2019 or thereabouts. And then their balance sheet became a little bit stretched. So the government started to take the burden of doing capex for them, not for them, as in they started to borrow and give money to the NHI and Indian Railways. Similarly, what was happening is Food Corporation of India, for example, they had to run huge subsidy programs during COVID, free food, 5 kgs of rice and wheat and some pulses, for example, which is the Prime Minister Garib Kalyan Yojana. That was funded initially by Food Corporation of India borrowing from the market and paying for that subsidy, right? But that eventually transferred to the central. So I think what has happened is that some of these PSUs, they were borrowing earlier, but then they stopped borrowing. So central government, it shifted. So the shift is less between state government and central government. The shift is bigger in PSUs versus central government. Let me put it that way.
Okay. Thank you so much, sir. So, one thing on the global economy part. So, I think yesterday or day before yesterday, I don't remember. The deficit data of US came out 8.2%, I think, and it's one of the I guess second highest in last 20 years, or
Yeah,
maybe after the Gulf War, it is the
yeah.
highest, something like that. I don't remember the exact aspect, but what do you see it meaning for India henceforth?
See, if India, so issue is that current account of US deficit, it widened very rapidly during COVID and subsequent 1 year because US government was giving a lot of money to the US consumers, US households, free money pretty much. And those households were spending it in a big way initially in the goods economy, because under lockdown you can't spend on services, you can't go out, you can't watch movie, you can't go out to restaurants. So, and they had a lot of money, so they started spending on white goods, doing their kitchens, buying cars. So the emerging market got a lot of benefit in 2020 and 2021 and partly in 2022. But what happened in 2022 is that the demand of the US consumers started to rotate towards services, as a reverse of what was happening in the previous 2.5 years or 2 years, because they overspent on goods whose benefits emerging market enjoyed, because when they spend on goods, emerging markets are the biggest suppliers. But when they spend on services like local watching a movie in US or going to a restaurant in US, that demand does not generate any benefits for the emerging markets in some sense. So now the current account deficit has bounced, has narrowed from the high point, but it is now sideways. Ultimately, world is better off when US deficits start to expand once again in a big way, where US consumers start to lever up. But that will happen when Fed brings down the interest rates. At such high interest rates, taking loans becomes little bit disincentivizing, right? So if Fed cuts interest rates and US consumer starts to lever up and starts to buying goods again, that will have a positive spillover on India and other emerging markets as well.
Got it, sir. Got it. But the chances of that going down is pretty low given the inflation, right?
Yeah, no, I think now the chances are increasing because inflation is consistently falling, and the commentary from the Federal Reserve is that starting September, which is this month, next month, they will start reducing interest rates. So I think the good news is that the global interest rate cycle is now moving lower. It has peaked out everywhere. I think rate cuts will happen many places, but these rate cuts, while they sound positive, because obviously rate cut is a good thing from equity market standpoint as well, but they often accompany weak growth as well. That's why the rate cuts are happening in the first place. So somewhere investors have to contend two things. One is, on one hand, lower cost of capital is positive for equity market outlook, but slowing earnings growth rate or disappointing earnings is negative from equity market standpoint. That's the world we are entering, to my mind.
Got it, sir. One second. All right. So according to you, what kind of inflation targeting has worked or probably will work much better for Indian economy in the upcoming years?
So I think I have a problem with the inflation targeting which we are currently doing. I think 4% is too low, first of all, and targeting at headline inflation level 4% is also not very best way to deal with it, because India's inflation has 45% food weight. That is among the highest in the world. And food is something which is fluctuating for various reasons, seasonal factors, monsoon related factors, disruptions, and those kind of things. Number two, they are difficult to forecast. And number three, interest rates are very little effectiveness of interest is very limited in ability to control food prices. Food prices are more controlled by government supply management rather than RBI's monetary policy. So if RBI is targeting headline inflation at 4%, which has 45% food weight, then essentially RBI is targeting half of its objective is to actually target food inflation, because half of the CPF weight is coming from food. But that's not a very prudent strategy, frankly, if you ask me, because then monetary policy will keep rates high when core inflation is low, but the food inflation is high, something which is happening exactly right now. Today, India's core inflation, which is the true pricing power of the businesses, is at series low, some 12-year low or 10-year low or something like that. But the food inflation is elevated, and as a result of that, the headline inflation is 5% or thereabouts. And therefore, RBI is keeping interest rates high so as to bring 5% inflation to 4%. But the core inflation is already at 3.5%. So basically, implicitly, RBI is trying to bring food inflation down through food inflation. But that's not a very sort of effective strategy, is what my point is. That's where the problem is. So I think what we need to do, my guess is, that we need to maybe allow a little more inflation in the economy. We are a growing economy. Our demography is positive. We have a young population. We need to offer jobs to the people. So a little bit of inflation is better. And second, we should either target it ex food, or we should take a combo of CPI and WPI so as to make it a little more broad-based indicator rather than very narrow, really with food component in it. That's what my sense would be, but we'll see.
Got it, sir. Thank you. Thank you so much, sir. So in terms of international trade policies, any particular, free trade agreements or reforms which you feel have been extremely beneficial in last 6 to 8 months or maybe in the upcoming year?
So free trade agreements, I think now the world is going, unfortunately, Shailesh, in the opposite direction where everybody is putting duties on everybody else. If you're following the international trade, you will notice that it all started with 2017. In 2017, with Donald Trump, president of US, putting tariffs on China. Now, what is happening is that in the last, until last 6-8 months, the trade tensions were bilateral, US versus China. The rest of the world was by and large okay, right? Now, what China was doing in this process is that, okay, if US is putting duties on China, China was rerouting its exports to US through Mexico and Vietnam back into the United States to avoid those tariffs. So China was not harmed by those tariffs at all. Now, what is happening is in the last 6 months, China has started to dump goods in many, many countries. Electric cars, China is producing electric cars at a very rapid pace. It is doing to Germany what Japan did to US in 1970s in terms of cars. So Europe has jumped into the bandwagon and started to raise tariffs. Indonesia the other day raised 200% tariffs on some of the Chinese goods. Canada 2 days back was raising tariffs. Mexico and Vietnam are sort of contemplating. In other words, the bilateral trade war is becoming multilateral trade war. So free trade agreements are actually getting compromised in a lot of this, to my mind. World is moving towards escalating tariffs. Why? Because everybody has a weak demand. Everybody's industrial production or manufacturing is struggling, and China is dumping goods. So typically the trade tensions escalate when the demand is weak because everybody is contending for that shrinking pie by taking advantage of tariffs and stuff like that. So I think free trade will not help so much in this. What might help, to my mind, is a relatively undervalued exchange rate. Because if you keep your exchange rate undervalued, it is effectively an import duty on all the imports in one go and an export subsidy at the same time, right? This is what China is doing. China is undervaluing its currency on real basis and trying to take advantage in exports, really. So we need to counter that through having our own exchange rate, which is little more competitive, is what my limited understanding on this is.
Got it, sir. Thank you. Thank you so much, sir. Sir, any particular journals you would advise these young budding investors to keep a track of on a monthly basis or on a weekly basis, or any publications which you would suggest for these guys to, constantly be in touch with or read on a regular basis?
Okay, so I'm guessing Indian pink dailies, obviously, all these who are interested in knowing about markets, learning about economy and all would be reading in any way. I would recommend read editorials for sure, not just the news items. That's one. I would also recommend from International Arena Financial Times, if people have access to it, will be very, very helpful. One of the finest ones on global economy and markets. Very, very necessary, I should say. Um, and other than that, I should say that one should read books of historical period as well, right? I mean, in art, which we are losing, unfortunately. Um, you know, um, John Maynard Keynes, who may not, who not everything may be right what he said, but I think he said he has a definition of what is a good economist, for example. I don't have it right now, otherwise I would have showcased it on the screen. He basically is saying that a good economist is one who is a good mathematician, a good philosopher, a good historian, um, and good economics all in one. When we go too much into specialization and mathematics, that's where we lose the economic intuition. What is happening to economics over the last 25 years, unfortunately, I should say, is that maths has overtaken economics. Now, which is not bad thing in and of itself, but it has come at the cost of economic intuition, at the cost of reading economic history, right? At the cost of understanding business cycle dynamic, at the cost of understanding debt, liquidity, international connections, and so on and so forth, right? So I always advise youngsters who join our office as well, or otherwise when I meet them, that enhance your reading about economic history. And it is relevant for financial markets as well. It's not just academic exercise, frankly speaking. Um, you know, for example, Great Depression, right? 1929 to 1933. Any good economist should have read Great Depression, frankly, because it was a game-changing event for economics as a subject. If you have not read those about that period, how it came about, what problems it created, how central banks slash governments resolved it, I mean, a lot of this toolkit, a lot of these interplay of forces will you'll totally miss, right? Similarly, GFC, Global Financial Crisis, Lehman Brothers fall, is also another event which was earth-shattering in some sense, so far as financial markets are concerned. Similarly, 1970s stagflation in United States, high inflation, low growth, very important period to study. Now, why I say these three periods is because that opens up economics for us. Otherwise, a plain vanilla economics, which is, okay, this month industrial production has gone up, inflation has come down, central bank will cut interest rates and all that stuff, will teach you only so much, right? As they say, good sailors are produced in turbulent seas, not in calm seas, right? If the sea is calm, he'll not be a very, very accomplished sailor. It's only when there's a storm in the ocean. So what are the storms in economic profession? Great Depression, 1970s, right? GFC. And I can recommend you, for example, Lords of Finance, right? Lords of Finance is a book by Liaquat Ahmad, I guess. I hope I'm saying his name properly. Um, it is a book about four central bank governors. It was semi-biographical account of four central bank governors: Federal Reserve, Bank of England, Bundesbank in Germany, and Bank of France in France. The four governors who lived through the Great Depression, how they confronted this huge tsunami, really. What was their interpersonal relationship, how it mattered to the policy making, what they understood, what they did not understood, what were the blind spots, it's amazing when you read this account, and a lot of things open up for you, frankly. So read, please. I mean, that's what my 1 point suggestion is: read economics and read beyond economics as well to enhance your capacity to think, right? So that's what my
Thank you so
advice would be, frankly. Yeah.
Thank you so much, Kapil sir. This session was very much enlightening. I'm pretty sure we'll have to pause the session quite sometimes to study the slides a little bit more in detail, and we may have a couple of follow-up questions, which we'll have to get in touch with you again
Sure.
from the session. I hope you'll give us some more time there.
Yeah.
And we just wanted to thank you for taking out time from your personal calendar over a weekend to be doing this for us. It really means a lot to us.
No, it's a pleasure. I always love speaking to people, particularly youngsters or otherwise, who are willing to learn about economics. I'm passionate about economics, and if somebody is passionate about economics, then I have all the time in the world, frankly speaking. Thanks for having me. Really enjoyed, and please read economic history for sure.
Thank you so much, sir. Thank you so
Thank
much.
you, everyone. I hope you found the session relevant and interesting. Thank you.
Thank you, sir.